Kenneth, it's unfortunate, sad but true that there is a second wave in India, and particularly in the state and the city we live in, which is Maharashtra and Mumbai. From a market standpoint, could this really derail the momentum which the economy had picked up? And could that be an indication for markets to either hit a pause button or to retreat?
So if you look at our past experiences with the marketplace, everything is postponed and it doesn't, and everything is postponed, right? So even if this thing does get infectious and it spreads right through, we essentially need a hiatus for a month or two before it moves on. So we've been through a number of phases, and I think we've come down to a phase where vaccinations have been administered or getting administered, not just in India but across the world. And it will take some time before you hit a critical population that has gotten vaccinated. So we've been through it for 1 year. We'll probably see another 6 months of this uncertainty that will be there before I think the world will come back to a little bit of normalization. So I think that's where the view is. In fact, for the marketplace, things have bounced back, valuations have come back, momentum has come back, inventory channels are getting full, trade is almost normalizing. So things are okay. I wouldn't say that they've gotten significantly better from where we left off, but things are okay, and markets have responded to that.
Kenneth, today steel stocks are higher because steel companies are enjoying what could be called as one of the best patches in their history. The impact of steel is visible how auto companies are reporting compression in their margins, and they're trying to pass on the price hike to consumers. At what point in time do you think the obvious concerns of inflation and margin compression will take over? Do you think we are going through that stage where markets should not continue to ignore what is happening to raw material prices, whether it is steel, paper, whether it is steel, copper, paper, or even plastics?
No. So I look at it a little differently, Nikunj. So there is always a pool of profitability in that value chain. For a very large part of the last decade, that belonged to all the users of the metal, or users of the commodity. Okay, what you're seeing out here is just a transfer of that profitability from one end to the other extreme. So here, when you look at the aggregate profitability, that may not change, and it won't. It will just shift from one company to the other. So it just moves up and down the value chain, which I think it's over a period of time, supply has gotten constrained in steel and demand has been at a steady clip. So I wouldn't say that margins will come back for the automotive companies, but definitely that shift in profitability is moved towards the commodity business. And in all likelihood, it will stay for some time till new capacities come up, not just in India but globally.
So how exactly will the template play out? Could this trigger a fresh Capex cycle by cement, steel, industrials and cyclicals? Are we on a cusp of where big corporate houses will come and say the following, which is, last 10 years we've not invested, but now it's time to put our shoulder to the wheel and we will start increasing Capex and will commit to both greenfield and brownfield?
Well, that doesn't happen immediately. We'll have to wait for a year or two to see how these events play out. Everyone wants significant amount of cash flows and everyone wants a high return on capital invested. Remember, a significant amount of these commodity businesses haven't earned anything for the last decade. And the reason why that happened was because excess supply came in between 2008 and 2011. It wasn't that demand fell off the cliff, right? Demand continued to grow at single digit, which it always does. But supply came in at double digits. So we had a situation where you had oversupply, and now you probably have that entire supply being consummated, and now you would have a shortage of supply, and that's where the transfer of pricing takes place, and that's where the transfer of of profitability happens in the cycle. I think some of these companies, or a lot of them, will enjoy this period for a couple of years before new capacities come up. The normal way to look at it is you look at brownfield capacities, and everyone in those industries that we're talking about have announced brownfield capacities. When they get exhausted and when the ROIs actually kick in, then you have greenfield capacities. But critical to all of this, and the best part of all of this, is that these companies now will leverage into an expanding cycle. Earlier in the last decade, you effectively have been able to pay back most of your debt. So I don't think what's happened on the ground, whether it's any of these commodities, what's there on the ground today, is that none of these capacities are financially unviable. Most of them that have survived the cycle are now financially viable, which means from reaching viability point, they become extremely profitable, and then you have a start of a Capex cycle. But it may not be as large as you've seen it in the past. It will be there, but not as big as you've seen it in the past.
So, Kenneth, in light of what we're seeing, are you still focusing on a 2 to 3 year outcome? Are you looking at things more from a more defensive or risk averse a point of view, at least in the near term? Which would be the themes that you would look at immediately, given that the markets have already kind of topped out and there might be uncertainty to follow?
Well, profit pools with the profitability of the entire marketplace or the economy will continue to grow. Now that's going to be a situation, then I can't see why we need to be defensive. What you need to essentially look for is where is the buildup of all this profitability, or where is the buildup of, as we call it, earnings growth. So I think that's the template that needs to come to work at this point in time. So if you look at the marketplace over multiple cycles, it's always moved from industry to industry to industry. Whenever one industry is hit peak profitability, the probability of that continuing to do very well into the next decade is less likely, and that has happened on multiple occasions, right? So the same thing is working out today. So if you had to ask me about the Capex cycle, and if you had to ask me about the consumer cycle, in the Capex cycle, what we are undergoing is something called decarbonization worldwide. The normal power plants that are there in the world, which is based on fossil fuel, they're giving way to alternatives. Now this is not because not because of any other reason, but very simply economically, these alternative modes of manufacturing electricity are very, very profitable and have reasonable amount of ROIs. You've seen that happen in India too. Okay, the underlying fuel basket is shifting towards gas. The power companies are incrementally, and most of the Capex that's coming up is coming up in renewables. You never hear about a company setting up another thermal asset. Now that's a lot of replacement demand coming on the ground, right? And including the transmission of or changing of fuel that is there. So that's also a significant amount of Capex that's going on the ground. When you come out on the other side, you will see cost actually come off the cliff. I mean, it's reasonably well known as to what are the the cost of power from a renewable source versus a thermal source or a fossil fuel source. It's reasonably clear what the cost of running an automobile on gas versus liquid fuel and so on, and so it gets. So very large parts of those buckets are seeing significant amount of changes, will lead to the next capital investment on the ground. Now when it comes to the other extreme, when you go into the consumer kind of an economy that's there, I think what happened in the last 18 months, which was a crisis, which was basically the pandemic, employment rates may not come back to normal very soon, and even if it comes back, it's going to come back at the bottom of the pyramid, where the spending parts are not going to be significantly large. So it's going to be at the top of the pyramid, and it's going to be at the bottom of the pyramid. So you will have volumes, and volumes will continue to grow. But in an industry like this, you probably won't have too much of pricing that is there, pricing power that is there. And when you don't have pricing power, any industry that doesn't have pricing power, and chief among that, if you ask me in the past, when we essentially started this conversation, commodities have the pricing power, okay, which is where all the profitability is shifting to. Our sense is that in the consumer economy, when the growth is at the base of the pyramid and you get significant amount of volumes, it may not come with pricing, which would impact margins, would impact capital efficiency, and those companies that have a fairly large run till now may not be able to continue that growth and profitability or those capital efficiency ratios that we've seen before. So that's my take on where it is. It's not about being defensive in the environment like this, because go back to 2008, 9, 10, and when we are coming out of the infrastructure cycle, the normative assumption was if India doesn't invest in infrastructure, profitability can't grow. Okay, and this decade has proven completely different.
Absolutely. Since we touched upon consumption in a roundabout way there, but nonetheless, Kenneth, when it comes to both, let me focus on staples for a moment. Where are you on that front? Is it perhaps the least exciting part of the market, or do you still see some merit there as we start to kick off a new cycle?
Well, I did mention that you will see volume growths out there. I'm not too sure about pricing. So companies will grow in single digits. Profitability will also keep pace, but the growth will be growth will be in another part of the market completely. It's not going to come in consumer staples for sure.
Okay, so just to get it right, are you saying that one needs to be underweight staples right now because of the inflationary pressures across the board, and they will only have that much bandwidth to pass on the RM costs on to consumers?
So when we run a product, when we've been highlighting this for a couple of quarters or probably a year or two, is that we basically seeing a shift in the profitability that exists in the industry. It's going back to basic materials. It's going back to It's going back to the Capex cycle, and industry profitability will start growing. This is going to be at the expense, and all of this, when I put all of this together, and it is hugely inflationary, and that's going to come at the cost of the consumer. Okay, so we probably sitting we are sitting at a stage and point where the profitability in the consumption cycle, which has grown all the way from 2010 to 2020, is seeing a shift. Okay, and that's because of inflation. Inflation is very good for corporate profitability, but it's not very good for the consumers. The consumer is going to have the same amount, is going to consume the same quantum at a higher cost. Okay, so that's how the cycle has, or we tend to believe is moving, and that's not happening just in India. It's happening is probably happening across the world. So yes, to a level, we prefer the Capex cycle, the manufacturing cycle, the companies that are going across and building a global footprint. We are a little apprehensive about the consumer and the domestic consumer cycle, so as to say, and we do not have a very large exposure out there.
Sure. How far into the IT rally are we, Kenneth? And more importantly, do you think with the kind of growth visibility that we have in the IT sector for not just today, tomorrow, 1 quarter, 2 quarters, but for the long haul, would you also say that the valuation metric, so to speak, doesn't really apply with IT?
Well, IT, I think the biggest challenges coming up may not be visible this quarter, but definitely next quarter onwards is the cost and the turnover and employee turnover. I think that's going to be a critical thing to watch out for. And I think and going into probably the June results, a lot of companies will be highlighting these challenges that are there. I think the growth is fairly there in most of the company valuations. Now, some of these companies some of them, or I guess all of them, have to surprise significantly on the upside. That is an unknown factor, because all the large companies have guided for almost 100% or almost doubling of turnover in 5 years, which they have done in the previous 15 years. They've always doubled turnover in probably 5 years to 8 years, and this time on a very large base they're talking about doubling turnover, doubling size. Now that's and that's significant, and I think if they can do that and maintain some level of competitive pricing, market will reward them fairly well. So if they are expensive, these numbers could continue to be elevated.
Kenneth, let's look at the environment which you alluded to, that pricing power is going back to commodity producers. We are looking at a fresh Capex cycle. Now, one way of looking at it is that if inflation goes higher, interest rates will go higher and markets will not reward such high P multiples. The other way of looking at it is that banks will start lending more, a new credit cycle will start, and growth is going to be the driving factor. So what happens to banks then? Because for country to grow, for Capex to start, banks will get more business. But banks, like you and me have discussed several times in the past, the raw material for banks is cash. And if the cash cost is going higher because of inflation, then banks should underperform. What is the right way of looking at banks, and especially corporate banks?
I mean, I've always believed that financial services or banking or the lending business is a late cycle play. We've got to have the first initial round of capital investment that's there, and once this is established, and if you look at all the companies that are there on the ground, they've got significant cash generation, and the cost of capital is coming down. It happened in the previous cycle also. It's only towards the end of the cycle where you have more participants coming in, okay, wherein financial services or the lending business gets pricing power. So I'll wait my time on this one. I have been doing so for a pretty long period of time, but this was more on the retail lending companies that were there. Till now, we've had the retail assets actually grow to probably their all-time high in the economy, even as percentages of the banking system. And there you'll get a pause. I think the corporate book will start expanding, but it'll take some time before banks will be able to establish significant profitability. So I'd wait my time on the banking system under this framework. Okay, they are late cycle plays. They will establish profitability when you have fragmentation of the business. I mean, just an example is that today steel as an industry is basically just six participants on the ground, right? Compared to what we had in 2000 in the last decade, where there were a numerous number of smaller companies that were setting up steel capacities. Today, all of that is consolidated in just about 6 companies that are there. So when you have the fragmentation of that industry that takes place, that's when banks start getting pricing on the ground, and that's when the profitability increases. So that's our framework of investing in the financial services business, and I think for us it will take some time before we actually get into that trade.
How are you resisting the temptation of not buying into internet companies, platform companies, network companies? Because that's where the market cap is getting created. That's where the growth is. That's where the listing is. That's where the participation is.
So I can't say we are not participating, because when some of these companies IPO'd, you could have explained their valuation with the cash that they generated on books, or the franchise and the cash that they generated on books. But yes, we at this time and at this valuations, I'm not too sure what we're doing, what to expect of some of these companies that are getting listed out here. So we're staying away from that. But let me just rewind a bit. A lot of these internet companies and a lot of these platform companies, while they are new in the way, in the mode of delivery of the product to the end user, it's not a business which is very new. I think the bigger businesses that you have which are platform based in the country or across the world is the banking system, right? And that's the biggest platform that you've got. It's just, it is there through a legacy system. Here you got a different mode of communicating with the end consumer. So yeah, so over a period of time, even that will get commoditized. When I look at it right up front, and you've got a number of individual companies that are sitting out there in various lines of business that are prevalent, whether it's financial services, or whether these are telecom providers, or whether they are retail B2B assets which are there. All of them have started with very large access to the end user, but their margins are wafer thin. And it's not that the competitive intensity is not there in these companies. The competitive intensity is significantly there. I think what advantages these companies do have is that the incremental amount of capital investment in the business is reasonably low, so they can survive at these margins. But yes, if it continues with these high valuations and such high ROEs, I think over a longer term period they will correct themselves. So you just have to wait your time, and the second round of investing in these businesses are much larger than the first round. So wait your time. Make sure you've established reasonable amount of I won't say knowledge, but if you get a hold of the business model and you get a hold of how the financials work, and in the second round, a lot of these will be very, very profitable, because you will get valuations at your price somewhere in down the line.
Well, Kenneth, appreciate your time. So glad you could join us, and wish you a wonderful day, and good luck for future.